And I mentioned a moment ago, this is another example that came out of Winning Angels, but it talks about a person that's going to invest roughly $1 million in this asset class. And the fact it's very important to think about this from a portfolio management standpoint. And so you can see they said we're going to our investment numbers are going to be between $25,000 on the low end up to $125,000 per deal. They were able to use this and say exit value possibilities of the companies I've invested in, what that expected value is, and what the return is if they're in that deal, in those deals for a 4-year period, which is about half the time that you can normally expect to be in an angel deal. And remind me to touch on that point in just a moment. I'm going to rifle through this very quickly. These are the 3 major buckets of where investing activity happens, starting at the validation stage. I talked a moment ago about those companies that are in their garage or basement where they're working on a basic idea. These are the attributes of what those companies look like. And for a number of years, we actually set up a fund that we could invest $50,000, $75,000, $100,000 to help companies vet these ideas. And the idea was to get the company to a point that we saw enough significant traction that when they came to the startup and early stage and organized angels, and they had these types of attributes for the company, we could see enough track record with those individuals to say this looks like a reasonable investment for the Queen City Angels to consider. And we've talked about the amount of money that they would typically need at this stage. Beyond this stage, they get into a growth strategy, and here it's more than likely we're looking at a way that we can either package up the deal and sell it in an M&A transaction, or to bring additional money in vis-a-vis a venture capital round. So how do we succeed? And the question was asked a moment ago, the types of returns that we would be looking for. These are some data that were put together by a professor from the West Coast that ACA hired back in the 2007-2008 time period. He went out and surveyed all the angel groups in the US and the UK, had about 2,000 exit deals in a database, and in those exit deals, he found that 5 of them, 5 out of 10, 50% of them were tax write-offs. And in a couple of the deals, they were break even. In other words, you got your money back or some point extra money. In a couple of deals, you got 3x to 5x your money. And what you were really looking for is one of those deals that could provide 10 times your money. So when we do the initial calculation of pre-money and the ownership that we're going to have in a company, we need to make some assumptions about what that exit value could look like, and then we need to have an opportunity to earn 10 times our money when we write that initial check. So entrepreneurs will say, well, that's greedy. And our answer to that is look at the data. We have empirical data to show that even though we love your company, we love your opportunity, we know that half of these companies are going to fail, which is an important thing for an angel investor to consider, because if your stomach doesn't allow you to deal with losses, probably not a good place to put your money, because you will have some, and there's all kinds of things happen. Murphy's Law prevails in these types of deals. But this is the same philosophy that venture capitalists use. So if a venture capitalist goes out and raises a $100 million fund, they're going to invest in 10 to 12 companies out of that fund, which means they're investing somewhere around $8 to 10 or $12 million per company, correct? They're looking for one company that will return $100 million, i.e. the fund. And then the return that they give to the limited partners would be from those other remaining companies that give them a positive exit. It's a very important concept. So we've been through national investing, just a couple of points on Ohio investing. When we started back in 2000, there wasn't an organized angel group probably within a 200 or 300 mile radius. Today, just in Ohio, we've got 10 organized angel groups. So if you're an entrepreneur looking for money, it's the best time ever to go approach angel investors. There's probably 7, 8, 10 groups in Kentucky, and maybe a half a dozen angel groups in the state of Indiana. And we do syndicate deals with all of those groups. In Ohio, we've got about 600 members that are represented through these 10 groups. We've invested in about 200 portfolio companies and about $90 million of our money. So if you think about that for a moment, 10 years ago, that would have been equal to a reasonable sized venture capital fund. And that happened because a lot of these VCs moved upstream. They quit investing at the seed stage level, which meant that the organized angel groups had to backfill that void in the marketplace. Otherwise, we would invest money expecting to get to a VC round, but then the company would go into this valley of death because there wouldn't be money to fund those next activities that had to be, and milestones that had to be hit in order for the VCs to invest in the company. Ohio is now ranked as one of the best states. We've got a great model for supporting angel activity and entrepreneurial activities. I'm going to just pick a couple of points on the next few slides. You can read these in your handout. We started in 2000 with 5 members. We're at over 50 today. We've invested more than $45 million of our money in more than 70 portfolio companies. We invest as both a club, which we can talk about that concept later, and also as a fund. And most of the other angel organizations in the state have been set up primarily as funds because the money came from the Ohio Third Frontier program. I know I'm probably using a lot of terms that you may not be familiar with. We can answer some of those questions later. And then we're all co-investing with other angel or seed groups in the state or around the region. Our goals is, it's just like in real estate, location, location, location. In our case, it's returns, 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 because that's the evergreening methodology that we have to use in order to continue this activity. But equal to that, and we think a winning recipe for an angel is a passion to want to do this type of investment, to want to work with these types of companies. Otherwise, you become that financial investor that we talked about earlier, low industry experience and low entrepreneurial experience. And those, you can still make money, a lot of money in those with that type of profile, but we're really looking for people that have a passion for this type of investing. If you look at our membership, which I think parallels most other angel groups around the country, it's made up of probably 50% ex-entrepreneurs and 50% of people who came out of corporate 500 environments. It's really important to have lots of external relationships. This is important for a number of reasons: to build deal flow, to help do due diligence on companies that we're going to invest in, to create syndications that allow us to provide the amount of capital that these companies need. So it's important to have these kinds of relationships in the community and the ecosystem. As you saw in a previous slide, it's important to have a defined process that you're going to take companies through. So when a company applies to us at the top of the funnel, we articulate to them the process that we're going to take them through in order to make an investment decision in that particular company. And you can study this, and we can answer questions later if you have any questions about it. I think it's also important to have specific deal criteria. Anybody that's going to invest, whether it's your own stock market portfolio, whatever it is, you've decided on some criteria that you're going to use to make those investments. One of the most important criteria is this idea that entrepreneurs are open to mentoring. And remember the example that I used for the product that came from Israel? What was the key issue with the CEO? Not open to mentoring. And that was a key component in that company actually failing. We have a paid person who gets up every day. We think it's really important to have an administrator that's running the group. That's what Scott Jacobs does for our group. You can see all the activities that Scott is involved in. These are some programs that we've set up in an attempt to fill the top of the funnel. And Scott can share more information with these activities with you. They're really important monthly activities and or annual activities that we're doing to build deal flow and to help entrepreneurs so that when they get in front of an angel group, we want them to have the best shot at getting funding. And when we first started, we'd have people coming to us. They had no idea how to write a coherent business plan. They had no idea how to get up and make a presentation when they got their shot in front of an angel group. And they really had little idea or no idea of how to structure the terms of the deal.